Futures, this is one of those mornings, and it's been, we've had some good mornings and more bad than good. Megan Horneman, Chief Investment Officer at Verdence Capital Advisors, joins us. Is this signaling some problems, Megan, or is it, we haven't had a 10% correction in a long time. We've got some pretty rich multiples. We've got a couple of back-to-back years that obviously you're not going to have every year. So would you call this a sign of impending trouble, or maybe something that could be seen as almost healthy?
I think it could be seen as almost healthy, and I still think there might be some room to go in certain areas of the equity market. But when you look at why this is happening, it's really not a big surprise. Trump campaigned on, disrupting different parts of whether that it's businesses or government, and we've seen that happen. I think what's surprising investors is the speed at which there's certain things happening, whether it's been just 6 weeks and all of the campaign promises that he's been trying to fulfill, and also the speed at which economic data is softening. I think most economists had expected weakness this year, but you have Atlanta Fed now looking for a negative 3% almost for GDP for the first quarter. So you're looking at economic data weaken quite a bit. I think it's more of a valuation, I guess you could say correction or reset. You mentioned valuations coming into this year were very high, especially in U.S. large cap, both growth and value. These things are just having to now reset with the expectation that the political turmoil will continue. Volatility is here to stay. Interest rates are still a risk to the market, and that we're starting to see earnings get revised lower as we see economic growth come lower as well.
And some of the highest flying parts of the market, and with the highest beta, like the NASDAQ, we're close to a 10% correction. The other night, I don't know whether you saw it, the address to Congress and the joint session. President Trump did not mention equities, but you heard him mention, I don't know if you heard him mention bonds. He said we've had a big, beautiful drop in interest rates. So they're noticing that. And that's something I know he likes higher stock prices, but he likes lower interest rates a lot. And, stubbornly, mortgage rates have stayed high, even though the Fed cut. So that is welcome, isn't it? And it can help inflation if rates come down in certain, you take your pick, credit cards, whatever you want to talk about. It's a good thing when rates come down.
Mm-hmm. Yeah, and rates most recently have come down. But keep in mind that long end of the curve is something that's very difficult to control from the Fed and obviously the White House. And that long end of the curve is what's going to dictate mortgage rates. These are the parts of the curve that are impacted by inflation. So I know that the administration wants lower interest rates, but it's really difficult to get that if we still have lingering inflation pressures. And we're seeing that. Take a look at the ISM Services Index yesterday. It was a better on the headline. It was a better report, but people are not talking about some of those underlying components like prices paid that's still over a 60 level. That's not telling me that inflation is coming down the way that it needs to be for the Fed to be able to come in and even think about cutting interest rates again.
I want to ask you a political question. So,
oh boy, here we go.
No, it's
buckle up,
okay.
Megan.
It's a good one.
Bring it on. Let's see.
I think the inflation, was still in the pipeline. I think Biden killed all the chickens, so I don't even blame the eggs on Trump. But the jobs numbers that we see tomorrow, or the GDP number. I've heard that this is Biden's job number tomorrow. I'm not convinced it's Biden's job number. You could see employers pulling in their horns based on all of this uncertainty. And this could be, I don't know, half and half, or this could be, I know you're going to see it blamed on Trump if the job numbers are bad.
Of course. But I don't think this is Biden. We can't say this is Biden because, as you mentioned, companies will start pulling back on hiring. I don't think that we can look at any of these employment numbers in the first quarter of this year and really blame them on Trump or Biden. This is a business decision. And even coming into the end.
It's not. Yeah, it's Andrew's fault. Whose fault?
But Megan, and maybe this is the wrong indicator. I was looking the other day at mergers and acquisitions activity in the month of January. So the president obviously becomes the president in January, but we know that he's the president in November. given all the animal spirits and everything else, you'd think a deregulatory things going on. You would have imagined there'd be a lot more mergers and acquisitions activity. It is down 30%, the lowest level since 2015. What do you make of that?
Yeah, I mean, keep in mind, the beginning of this year, we were looking at a bond selling off as well. So if you have the interest rate environment, and then you have less certainty around what the Federal Reserve can do, a lot of that also has to go off of what's the interest rate environment from an M&A perspective. And it's just clearly, there's clear uncertainty. We also saw that in the small business sentiment. We've seen that for several months now. So I think that has a lot to do with why you may be seeing some lower M&A activity. And again, that animal spirits that came right after the November election, part of it had to do with optimism around Trump and how he would be from a regulatory standpoint. Absolutely. But also, I think it was just that there was no uncertainty around the results of that election. And coming into the election, I think there was some talk we may not have a clear winner, that it wouldn't be, a landslide. And this was pretty much a landslide. So that was taken off the table. That's why I think you got that animal spirits and equities. We've seen this before. Equities can be very overvalued, and we don't know when that will, that valuation correction will just come in. And that's what I think we're seeing now. So that's going to put companies on a little uneasy as well. So that doesn't surprise me.
Then I was we don't have time, but these, tariffs, if it doesn't last forever, that really could be higher prices, but not inflation. This could actually be transitory stuff because you're marking up prices because of some exogenous event like a tariff. Because we've had people come on and say that inflation is caused by printing too much money. So this could be the type of transitory inflation that the Fed was thinking we had the first time around when it really was printing too much money. But if prices go up, they wouldn't necessarily stay higher once you take the tariffs off. So I'm not sure it really is permanent inflation in the system unless it's permanent tariffs, I guess. Then it would. I don't know. There's so much to think about. That's why the market's down 400 points today. Megan, right. Thanks for your time this morning. And do you have a final thought or
No, I think it just from the tariff perspective, you're right. If this is a one-time tariff, that may not impact inflation over the long run. Right. But we haven't figured out the other inflation stuff that we were dealing with before tariffs were even a factor.